Welcome back, passive income investors alike, to what I'm going to consider the best investment strategy moving forward in 2020. And no, I'm not talking about Vanguard index funds, but this is where my thesis is going to begin as I reveal to you a practice portfolio I put together that I think is even going to outperform my individual investments. Heck, I think this is going to outperform Tesla, gold, Bitcoin. It doesn't even matter what you're going to compare this strategy to. But as I further explain, let's get right into this.
Drop it.
We have recently been going under a new phase of investment strategy that is dominating the markets, and this is ETF Index Investing. Most of us as passive investors want that safe, steady return with market average being around 10%, which has been doing much greater over the last 5 years. And Vanguard and BlackRock are the two largest pretty much ETF companies out there, growing by hundreds of billions of dollars a year to the point where nobody is talking about this. Currently, Vanguard is estimated to be worth $5.3 trillion. Let me say that again. Vanguard is managing about $5.3 trillion, growing by hundreds of billions a year. In fact, I've dug so deeply into this, I couldn't even find articles on it except for one from 2015 when Vanguard was only worth $3.4 trillion. So why am I telling you about this? Well, it's the ignorance of the market that I think is going to cause an impending bubble. But in the meantime, this impending bubble is going to overinflate some of these top 500 companies in the market. As many of you know, when you buy into an index fund, you're buying a basket of stocks, specifically with VOO or SPY representing the S&P 500. You are buying the lump sum of the 500 largest companies in the US. Whether they are good or bad, you are going to be owning a small share of them. So when you hand your money over to Vanguard, they redisperse it into these companies. And I think this is one of the best reasons why you do not play around with shorting the top tier companies. I look at a lot of people trying to short Apple and Microsoft, and you watch them fail time and time again. And there are a few things going for these top tier companies that people just don't grasp, because if hundreds of billions of dollars a year are pushing into index funds, and the top listed holdings on these index funds are Apple, Microsoft, Amazon, Facebook, JP Morgan, Berkshire, Alphabet, Johnson & Johnson, Visa, where do you think the largest capital gains you're going to experience are? Well, probably in these top tier companies, because even Apple and Microsoft have been known to do share buybacks on quite a regular basis. So you're getting this weird flux in the market where ignorance is driving into ETFs. ETFs are driving, these top tier companies higher and higher, leading Apple to trading at a multiple of about $1.4 trillion and a PE that it hasn't seen in probably over a decade. I mean, Apple has always been seeing a PE between 15 and 18, and now we're at 25. And Microsoft is always trading around a PE of 30, and it's never been able to come down. Now, I'm not telling you this not because I want to batter your investment philosophies if you are primarily an ETF investor, but the reason this is becoming a bubble is it's ignorantly based. As recently, I was making a video on Charlie Munger talking about this big flux going on of people moving away from the private investing market, mutual funds, into these larger ETF kind of automated investment strategies that have low cost, that are the most passive. The problem with this is ignorance really starts taking over the entire landscape of investing, because people that buy these funds, they don't care. They don't care about the individual stocks. They don't care what they do. And it causes this massive inflation of the market. Do I think the markets are overvalued right here? Absolutely not. We are sitting at high values for sure, but we're not talking about another 2008. We're not talking about a tech crisis, but where are we headed? I think we're going to be heading into an ETF bubble and also a top tier bubble within the market within the next 2 to 5 years if this pattern continues. So how can you become profitable off this pattern? Well, if you went ahead and bought the Vanguard index about 5 years ago, we could see that your rate of return would have been around 62%. But that's based over the 500 companies. Whereas if you were to core focus your income on these top tier companies, say with Apple or Microsoft, over the last 5 years, your rate of return would be almost triple that. And I think this is a direct causation of not only the markets performing well, but these massive influx of hundreds of billions of dollars going into these higher weighted percentages of these specific companies within the Vanguard index. And then on top of that, they're doing share buybacks. Like, we have this perfect formula right now for these top tier growth stocks. So what I went ahead and did is I took all of these companies and I added them into a practice margin account within my stock portfolio. And this is all fake money. It's not my own money. I just did this now while the markets are kind of pulling back a little bit, but I'm making a bet with you that these companies over the next 5 years are going to, if we do not see a recession in the nearing future, are going to severely outperform any other portfolio management, mutual fund investment, even an ETF out there. And it's purely because this Goldilocks run that we are experiencing related to all these causation and factors. And I don't think people are paying enough attention to this. And it's something that I've talked about excessively as of recent, talking about how you want to own these top tier companies. Now, I preferably want to own the best ones and the ones that pay dividends. So many of you know I hold Johnson & Johnson. I've been recently buying Wells Fargo, though it doesn't sit in the top 10. I already own Microsoft. I've been buying Apple. And recently, I just loaded the boat on Facebook. All of these companies are specifically poised to do well against any other stock I can compare it to. Now, you could buy value stocks out there. You could buy small cap stocks that have been doing fairly well. Absolutely, 100% But are you going to get 100+% rate of return a year or something like that? I don't think it's going to happen as fast as it's going to happen with these top tier companies. Sure, these companies are worth trillions of dollars. They are sitting at higher values than they're used to, but I think it's because of ignorance. I think it's the flux of the market, the fact that we also have people doing fractional share buybacks within Robinhood, M1 Finance. It's like this perfect storm is kind of convoluting. The fact that real estate hasn't had real growth behind it over the last 5 years. The fact that real estate costs so much people can't afford to get into it. We're all pushing farther and farther into the stock market. And I think we're going to start pushing into bubble territory if this continues. Is it going to continue? The problem is, I think so. And that is why I've been personally loading the boat on these top tier companies that I do plan on leveraging down in over the next 2 years. So long as we do not have a black swan event or the coronavirus doesn't become a pandemic, I honestly think this is going to be the best performing investment strategy based on this future bubble that I see impending. And I know this isn't like the best news out there for value investors, because as a value investor, I look for kind of those on discount companies that have real potential to turn around with their bottom line earnings and their assets growing, because that's how stocks usually get valued, is basically they make money over time. As they make more money, your assets go up because the company is growing. But the way this market works is assets aren't going up as fast as the market is going up. And again, this is something that you're going to have to pay close attention to. It is something that is changing the landscape of the entire economy. Well, things are good. This is great. But heaven forbid something causes a massive flux and people start pulling extremely large amounts of money out of these stocks, because as much as I see an upside, the downside is going to be 10 times worse. Because if people get scared, if people want to preserve the wealth, because I imagine a lot of these people are a bit older and not all of them are young getting into this, and they decide they want to protect themselves and something bad happens, and you see hundreds of billions pull out of this Vanguard index fund, well, you're also going to see these top tier companies losing massive amount of share value. And this is such a weird thing, and it's just such an interesting topic. I can't believe absolutely nobody out there is talking about this, and it's just briefly being mentioned by like the billionaires like Charlie Munger. Heck, I saw Financial Education even talking about this. So this is why I'm trying to find a balance right now of primarily going forward, focusing on top tier companies while also building up my structural, what I would call my protective companies against downturns. Because though I think Microsoft and Apple could survive a recession for sure, they're not going to perform well in a recession. I honestly think my sin stocks and these lower tier S&P companies that don't weight nearly as high as these top tier companies do, I think in the long run, if we do see some kind of correction or crash, are going to actually start outperforming. So in the meantime, I'm going to continue to try and find this balance. In the short term, as I mentioned, I am trying to primarily focus on these high yielding stocks like Facebook, loading the boat to see if I can get to my goal of $200,000 invested by the next 2 years from now. I'm currently sitting on $150,000. I do believe there'll be some fluctuations along the way, but if this stream keeps rolling the way it is, I cannot foresee me having any issues getting to a 200K mark. I'm going to keep my ears and my eyes open for any warning signs that could lead to some impending issues. But remember, even if these stocks stocks hit bad news, there are still hundreds of billions of dollars flooding into these ETFs to constantly protect them against any downside risk. So next time you're on your forums, you're floating around and you hear someone talking about, oh, I'm going to short Apple, remind them of how stupid of a decision that is and how they're probably going to go broke doing it, as everyone in the past has. These companies have too much going for them right now. It is a good thing, and I think it's going to potentially become a real bad thing in the nearing future. But in the meantime, I'm going to try and profit off this knowledge and see how it goes forward. And it's going to be interesting to keep you guys updated, as I removed a monkey account. I used to have another dumb account where I just had random stocks. I got rid of all that because honestly, it's not performing well. I can't see it being that entertaining moving forward, as much as I think this strategy of holding these top tier companies and forgetting about dividends altogether might actually benefit you. So let me know what you think in that comment section below. What a fascinating video for Valentine's. If you guys don't have Valentine's, at least hopefully that money you're saving is going to be going towards some really great investments. So stay cool, stay awesome, guys. And heck, I look so forward to chatting to you real soon.